Good morning. You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
All right, welcome back to Insurance Matchmaking. This is part 2 of my visit with Danielle Ross with One America. As I knew, fortunately, I had the time to do the recording because I knew that just one show was not going to be enough. And she came in and I actually didn't even cover this in the previous show. I talked about how One America is in Indianapolis, and it's near our headquarters for Gordon Marketing. That You're from what, St. Louis?
Well, I live in St. Louis, and I grew up in Indiana.
You grew up in Indiana, and she drove down to meet with us and help us out so I can help my clients a little bit more with their long-term care needs. So it's kind of neat when you got people who actually get in their car and come to see you to help you.
Sure.
So that's always fun. But we were talking about the whole life options and the annuity options in the previous show of doing for long-term care, and we started in on it. We were talking about the whole life, that you can use that. It's called asset care to fund long-term care, and you can get that policy age 35 to 85, right?
That's right.
It's not designed for younger people. I have other options for insurance there, but we do like the final expense insurance. Some of those are whole life. They're usually designed for, again, people who put off getting their insurance. They didn't get it when they were young, and then they realize, I don't want my kids to have to pay to bury me or pay for my funeral or whatever, so I need to get some other insurance, and I'm not in the best of health anymore. And so those plans are a little easier to get, but they'll have minimum ages to be 35, 45, some even 50. Right. And especially the ones that will do what's called guaranteed issue.
Yeah.
You know, they won't do just anybody, because one of the things is the guaranteed issue plans, because you can't qualify for anything else, and the insurance company knows they're going to have a claim. Yeah. So they limit it. Yeah. They limit who all can get the policy. So most of the time it's, but if you hold on to the policy, it will pay out. And I'm not sure the stats on whole life. I know term insurance, and you may know that less than 10% of term life plans.
I think it's 5.
Is it? Yeah, I know it was less than 10. I know it was single digit. Ever pay out
because they're done in 10 years or 20 years, and people don't renew it.
Yeah, or they cancel. They didn't. They can't keep up their premium. So there's all those reasons. Right. And again, I think also included in a lot of times you'll have term life through your employer.
Correct.
So when you change employers, that plan goes away.
That's right.
So that's how the insurance companies make their money.
Right. It's always best to buy your own if you can.
Yeah.
Outside of your employer because of that, I think.
Right. Yeah, and I always tell people, take what they give, especially take what they offer for free.
Right.
I mean, and if you want to pay more and get, because sometimes you can get a very good rate on it if you add to it.
Right.
But just know you don't own that policy. Now, some companies will let you convert and start paying the premium yourself, or you have to pay the higher rate now because you're paying it directly. But, one of the downsides of term insurance is, as we mentioned, a lot of times it doesn't pay out because, well, congratulations, you paid for 10 years and you didn't die. Right. So you count that as a plus, but that's money out. That money's gone.
Correct. I think you bring up a good point, though. A lot of people have old life insurance. And that is something that you can convert into the long-term care insurance, which I don't think people realize, because you can grow out of needing life insurance for each other.
Right.
Or you paid the house off. The kids are grown. So now why not make it work for yourself, for your own health care? So if you have old life insurance, bring it to Matt and let him review that, because that could be a good thing that you could do that you already have laying around and don't even realize it.
Yeah, I have some people I had somebody that was like an antique car collector.
Right.
And he's like, I don't need burial insurance. She can just sell one of those cars, And it's
not quickly.
But not exactly, but not quickly. I saw a training one time and it was talking to, farmers. And I think I've shared this on one of my shows before. Is the farmers, we've got all this land. We've got money. It's like, yeah. But do you want to keep the farm in the family?
Right.
You live in that part of the country to know you got these 1,000-acre, multi-1,000-acre farms, and they end up being corporate farms,
right?
Because the family has to sell the farm.
That's exactly right.
We used to use the term "bought the farm." They have to sell the farm to pay the inheritance taxes.
Oh, absolutely. And you don't think your neighbors know that you just died and they've been eyeing up your land for a while? I grew up with farmers for grandparents. You're not going to sell it at top dollar when it's a fire sale.
Yeah.
Because it's just you passed away or you were very sick and you started having to sell. It's not a great option.
And depending on your age, now I'm talking term insurance in this case, but, you can get $1 million term insurance for
peanuts.
Peanuts.
Really,
yeah.
Really.
And your loved ones can take they take that money and they pay the taxes and the farm stays in the family. And even like you said, what we run into a lot of times, and we talk about the corporate farms, is the kids don't want to farm. They don't want to inherit the farm.
Right.
But as you said, fire sale, they don't want to sell it at fire sale rates and give half of it to taxes.
That's right.
We talked about taxes. What's the beauty of life insurance?
Tax-free.
It's tax-free. It is not income. I don't care if it's not a lottery. A lot of people look at it like the lottery.
Right.
Lottery's going to take half. Income tax can take half if you hit the lottery. Life insurance is not income. So I don't care if it's a $100,000 life insurance policy or a $5 million life insurance policy. That's not income. Now, having that money can affect if you're on benefits.
Sure.
But again, if you got that kind of money, you're not going to be worried that you lost your Medicaid benefits.
Right. Well, and you do Medicare, so you deal with the IRMA and the extra.
Yes.
So sometimes getting money that's taxable, like bank money, I use that as an example, but it could be anything, stocks, anything.
Right.
And you put it into a life insurance, whether it has long-term care or not. Now you don't get upcharged for your Medicare, which is crazy. I looked at the rates of that the other day. I couldn't believe it. My sister-in-law was complaining about it. I said, it can't be that bad. It's bad.
Yeah. I mean, the Medicare Part B premium for most people is $174.70. It can be $500 and some dollars if you've got the. And I tell people I do my turning 65 Medicare Welcome to Medicare workshop, and I say, and when I get to that slide, I said, I apologize. I didn't know you 2 years ago.
Yeah.
Because Social Security looks back 2 years on your income to assess, you had to. And that, again, we talked about these IRAs.
Yeah.
Don't just cash it out.
Right.
I actually just recently talked about a show. I had a lady. She would qualify for the low-income subsidy for her Part D.
Okay, yeah.
But she cashed out her 401k when she retired in January.
And that gave her a big.
So she's got income this year, and she's got some money in the bank. The two things, working next year, she'll probably qualify for.
Yeah,
well, and she takes that, the infamous Eliquis.
Okay.
So it's like she's going to have the, and I hate to use the term, but the donut hole. But we're talking about the life insurance.
Right.
Don't just cash, think, well, this IRA is not that much. My 401k didn't have that much in it. I'm just going to cash it out, pay the tax, and I've got the money. You can roll it into annuity care and fund your long-term care and not pay tax on it.
That's exactly right. And tax-free health care is where it's at.
We
want that. But, I wanted to say something because I always forget that people tend to think of nursing homes when we say long-term care.
Yeah.
And
great point.
Yeah, and 80% of the things we pay for is home care. People want to stay at home. And then you have a little bit of assisted living, and sometimes you go back home, or a little bit of nursing home and go back home. But there's very few people that are in a nursing home at the end of their lives. In fact, most people are not. Most people pass away at home. And I think that's encouraging. Who wants to be in a nursing home? And
right.
Of course, they take care of our loved ones when we need that and that kind of skilled care. But I don't want them to think of long-term care that way because most people are living independent, at-home kind of lives.
Right.
With assistance when they need it.
Now, what are the limitations on the care? And is it, I'm trying to remember. You correct me if I'm wrong. Is it indemnity or does it have to be licensed care?
Well, it has to be licensed care. If your state licenses home care people and assisted living and nursing homes, then it has to be licensed care. Although we are working on something that's coming out that's going to allow some informal care as well. Right. So that's coming out in a few months.
So that's one of my selling points of what we talked about in the previous show, the short-term care.
Yeah, it is.
Depending on, and not all of them, some of them are, still it's got to be licensed care, but the other ones are indemnity plans. And, one of those big fancy insurance words, but, indemnity means it pays you. You have to have the qualifying claim.
Correct.
I can kind of think of, years ago we had hail damage on the car, and they just gave us a check.
Right.
We didn't have to go to the body shop and get it fixed. It just kind of like, okay, it's going to affect your trade value when you go to trade it in. Here's, $1,400, $1,500. I don't remember how much it was, but it was a nice check, and it was like, the hell,
right.
It wasn't that noticeable, but it did have hail damage. So, we took the check. One of the things you talked about the memory care, just the, you want to stay in your home.
Right.
And one of the things, with the short-term care plans, and I'm not saying get a short-term care and don't get a long-term care, but sometimes you don't have the ability to get that long-term care, but you can get the short-term care, or you can use it as a bridge, because a lot of times to keep your costs down on your long-term care plans is you have a longer elimination period, whether it's going to be 90 days or 6 months before you start using those benefits. You might want to bridge that with a short-term care plan.
Right.
And one of the plans I have, like I said, it is an indemnity. You have to have the qualifying event. You have to, be diagnosed that you can't perform 2 of the 6 ADLs, activities of daily living, or a memory dementia diagnosis. That's an instant trigger, as we say. But you can start drawing the benefits. And like I said, it's an indemnity benefit. So you drawing the money, you spend it however you wish, whether you're paying the neighbor kid to mow your lawn or hiring someone to come mow your lawn every week, or you have a family member that's going to quits their job to take care of you. You can replace that lost income that they're having by, hey, I got this money. You can quit. If you'll quit your job and come take care of me so I can stay in my home, I'll pay you. And it's usually not the person saying it. It's the children. It's like I always tell people that work in like home health it's like, your clients are not my target market.
Right.
But the one who's probably paying for you to take care of mom and dad, they are. Yeah. Because they're paying for mom and dad and they don't want their kids to pay for them.
Right. Right. I was just talking to somebody about the home care situation the other day because my neighbor, who I've had for 30 years, passed away recently during COVID. But do you remember when everybody was bringing their moms home from the nursing home because of COVID?
Oh, yeah.
And everybody's just freaked out about them being in a facility. I mean, that home nurse came every single day during COVID. Never failed, never changed. They just considered her like one of the people that she was hunkering down with, I can't remember what they used to call that, and it really made me think this is what she would want. This is what she would want. This is what I would want, right? So going to a nursing home, we just want you to know it's not our goal. That's not what Matt and I want you to do. If it happens, it happens.
Well, and I know people that had to, go outside the window and wave at, or maybe be on the phone with them, but hey, we can't come in.
Yes. So, being at home with your own family, I mean, that I think makes people healthier and they live longer, actually, when they do that. So, and maybe go in because you need fixed up now and then in assisted living. So,
and a lot of people will confuse with Medicare. They'll confuse, the skilled nursing.
Yes.
Skilled nursing is temporary.
Yes.
And it's limited.
Yes, and they can cut you off early, and they do. They cut my mom off because she wasn't doing that after a hip replacement, she wasn't showing improvement.
Right.
If you're not showing improvement, Medicare's out, which means your supplement or Advantage plan are out. So that's another reason you have some of what we're talking about today.
Right.
Yeah, whether it's short or long. It would pick up, right. It would start paying that.
Yeah.
Yeah.
So that's kind of covered the short-term care, the long-term care, or how bridge on that.
We were talking about payments too, how they pay. I had a question the other day that I thought, well, that's a good question. I'm an insurance person. I don't think of this. But she's like, well, what if I only paid for a month or the first year and then I needed it tomorrow? She thought maybe the insurance wouldn't pay. I said, oh, no. I mean, it'll pay just like if you wrecked your car the day after you paid premium. So I said, your lifetime plan is
there's a lot of plans, and some plans will, like some of the cancer plans I mentioned, you can't have a cancer claim in 30 days.
Oh, yeah. Yeah.
Because it's kind of indicative of you were kind of wondering about something. You felt a lump and you got the cancer plan, and then you go and get, and then you go get the biopsy and, it's cancer, So even if you think it is, then wait wait 2 months before you go get checked. I'm not encouraging, and that still technically would be insurance fraud because they'll investigate sometimes. Some companies will, wait a minute. What did the doctor say on your last checkup?
Right.
And if they say, well, we're watching this lump, they're not going to pay because there's something, it was something that was already it's considered pre-existing. But everybody worries about this. Like, what's the point of, if something happens in the first 30 days, you have a free look period too. So, It's like they have to, if you decide to cancel within 30 days, they have to refund your money.
Right.
We hope you don't do that. And what happens to us, people like me, I get what's called a chargeback, and those are never fun. Because I don't like money coming after having to write a check to the insurance company because I just had to do this past week. Somebody had a plan for 2 months and decided it. Well, or they decided after they drafted the second month, go, no, I don't want to keep this policy.
Right.
Well, it happens.
It does.
All right. Well, believe it or not, we're
we?
on the break on our second show,
okay.
so we've got one more segment to do.
Looking to spruce up your home without breaking the bank? Visit Habitat Restore for incredible deals on furniture, appliances, home decor, and more. Plus, when you shop at Habitat Restore, you're not just getting great deals, you're also supporting your local community. Are you looking to make a meaningful impact? Consider donating to Habitat Restore. Your generosity can make a world of difference. Habitat Restore, open Tuesday through Saturday, 10 a.m. to 6 p.m., and located at 560 South Jefferson Avenue in Cookeville.
Hello, this is Mark Gaw, your local Twin Lakes Business Solutions consultant. As weather warms up, it's easy to let your guard down, but we're here to ensure your business stays on track. Explore Twin Lakes customized solutions designed for your business of every scale. Experience lightning-fast fiber broadband speeds up to 10 gig, dependable phone and conferencing services, and round-the-clock tech support to keep your operations running smoothly. Don't let your business miss a beat. Reach out to me today at 931-823-5511 or visit us online at twinlakes.net.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
Welcome back to Insurance Matchmaking, second segment of my second show with Danielle Ross with One America, and we were talking about some of the things with long-term care, and we kind of came up with a couple of things we wanted to cover in the break. The first one was we were going to talk about, what the risk is, but I want to cover, we talked about rolling qualified funds.
Right.
In the tax advantages there. And then you thought, I forgot to mention, sometimes people have annuities that aren't qualified funds.
Yes.
And
just to clarify what that is, because a lady asked me that the other day too. She says, "Now," I said, "Is your annuity qualified or not?" And she didn't know. I said, "Did you start it with like a chunk of cash, like a CD or something, and put it in there?" And she's like, "I think it was bonds." I said, "Okay, so you started it not with an IRA." Right? It wasn't your 401k or IRA. Okay. And she said, no. I said, okay, then it's non-qualified. I said, do you remember how much you put in? And she said she put in $50,000 and it's worth like $125 now because she had it at 2 or 3 companies, go for a rate or whatever. And I said, so you're right then. What I was telling you is that whole $75,000 of gain that you have in there, that can come out tax-free for your health care and not just your long-term care, but your husband's. Because I see you have a husband sitting beside you. Looks like you like him. I saw you two sitting in the bar, and put him on there. And then you can both get monthly long-term care off of your IRA or your annuity, your non-qualified annuity. Yeah. So non-qualified just means you started it with, cash. Right? Yeah. So anyway, that's a really good option.
I know. Like I said, I'm talking to you. Well, you know what I mean when I say qualified and non-qualified. And I realize, sometimes we need to step back and explain what we mean.
That is so true.
Because it's a term we use every day.
Yes.
But when we talk about qualified funds, she said it. Your IRA or your 401k, those things that are tax deferred. Yes. That's what makes it qualified.
Yes, that's right.
But the beauty of, like you said, well, you had gains in this, but you move it into, and when you draw it for long-term care needs, because you have to have the triggers. I mean, you can draw the money out any time,
right.
But if you just draw it out, then you may have to pay tax on it. But if you show that you're claiming it for a qualifying event,
that's right.
Then it's tax-free.
And you have to move it in this specialized kind of annuity that the IRS has qualified. So you can't leave it in your old annuity. You can't move it to any new annuity. There's like 2 companies, ours being one, that can take the money, make the IRS happy that it's the right language, it'll pay for your home care and all of that, and they'll let it be tax-free.
Right.
I mean, the only reason they did that is to get all of us off of their books for health care, right? So we don't end up on Medicaid and stuff. So they're like, we'll give you a tax advantage for that. But a really good one for people to use.
You mentioned, and this is kind of a segue, but you mentioned Medicaid.
Yes.
one of the things, and it may have been even a One American training that I hadn't really thought about it, but you have people, a lot of people think, oh, I need to do that Medicaid spin down. I need to transfer my house into a trust or, put it in my kid's name so that when I move in the nursing home and it's like your retirement is $8,000 a month, you're never going to qualify for Medicaid.
That's correct.
So not
correct.
everybody, and the other thing is, if you do, it's there for people who need it. But do you know what happens when you're on Medicaid and you need to move in a nursing home?
You have to go into a Medicaid nursing home.
Yeah, the one they pick. Not the one that might be, on the other side, across town or around the corner.
And not at home. You have to go into a nursing home.
Yeah.
And it's not the greatest. That's how I started in this all those years ago. My grandparents got into some pretty gnarly situations back in those days.
Right.
So I agree. That's it's not ideal. We want to plan you into financial independence, not dependence.
Right. Now, and we wanted to talk about the risks.
Yeah. Most people don't understand what the risk is outside of what Medicare pays for in your supplement. For this care, which means it's the custodial, non-skilled care that they would give you, it's for a man 65, so it'd be more if you're younger. Okay, is about $400,000. For your wife, if she's 65, again, this would be bigger if she's younger because you've got inflation. You have to calculate. It's about $700,000. So for that 65-year-old couple, that is $1.1 million.
Yeah,
that is a lot of money, right? And then if you do a memory issue between either of you, it's $1.5 million. So when you buy a policy with us and we say we'll pay it for life, we have a man on a 20-year claim right now with Alzheimer's. We're still paying for him. His wife used it first and passed away decades ago. I mean, I always say we lost money on him. It's just a joke, right?
Yeah.
But that's why you buy insurance, because you don't know if you're going to be that person. So we put aside $1.5 million for every person that buys our policy with Lifetime. And how many people out there have $1.5 million to put aside and say, oh, I'll just take care of it? They don't. They might have it in land. They might have it in illiquid places. But that's not the same thing. Right. It's having to have to sell those things off. So just so you understand why Matt and I are so passionate about at least having this conversation and making sure that you're protected. That's what we're doing. This is the numbers we're working with.
Yeah. Oh, gosh, what was it? Somebody said something yesterday, and it was if you're only doing it for the money.
Oh, yeah.
No. You're not going to, you won't succeed. You might make some quick money, and I don't know how many times. I actually kind of joked. Maybe even might have said it last week on the radio of, I enjoy doing my ministry, but I want to do a little bit less of it because it was just a situation. There was two people that one I helped and ended up not being a client, and part of it was she'd had some issues with a provider that were charging her a big lump sum up front, and we're like, okay, maybe it's something to do with this insurance company. They don't like it, and we switched her plan. Mm-hmm. And then she went for her regular checkup and was scheduling for the next week, and she was showing him her new card because this was in March, so it wasn't April yet when it was going to start. And they're like, oh, we don't take that. Even though they showed up on the website, they showed up on the carrier website as being in network with the plan. No, we don't take that plan. What you need to do, because this is what's really strange, a lot of people don't realize, with Medicare, once I've submitted a Medicare application, for at least for like Medicare Advantage and Part D, a little bit, I can't withdraw that application. I can't, it's like, when I started, we had to fax in the applications. Yeah. Legally, I was required, even if they didn't want it, if I'd already accepted the application, I was supposed to send it in. Until you have to call customer service and request to withdraw your plan. Well, and the thing was, the plan that she had with the company she was with, she should have been on a different plan. But since I was trying to switch her company for maybe some better coverage, I said, no, you need to call them, but you probably need to call the company you have now to say, hey, don't cancel that policy. I'm going to keep it. Yeah. Well, their internal salespeople put her on the plan that I would have put her on. So she's not, I can't put her on a plan. So like I said, I did ministry work. I didn't get paid for helping that person, but I still feel good about it because I helped her. And sometimes that's the biggie there. It's like, okay, I didn't make a lot of money, but I know this person's taken care of. Right. And actually one of the things I put on my Facebook is, it was tax time. It was kind of more of you have to have that 1095A form
Right.
to reconcile the tax credits you got on your ACA plan. I said, even if I'm not you're not my client, but you haven't got the form, you want some help with that, send me, go to this link and send me the consent form, and I can get the form for you. But I have to have that proof that you're asking me to help you, but I can help you for that. Because it didn't take that much. It was, one of those customer service things of,
nice
you hope you get a client out of it if, if I do enough of them. But it just didn't come out, but it's okay. Any closing thoughts? We're coming up on the end here.
I mean, I would just tell you, I will make myself available to anybody from, that's listening to your show. If we can do it virtually or when I'm in town, if you would like my help with your planning, I'm happy to do it.
All right.
Yeah.
So
and thanks for having me.
Yeah. I'm glad you could make it. And hopefully the drive wasn't too bad.
That's beautiful.
Now, did you stay here in Cookeville?
I did. I stayed at the Holiday Inn.
All right.
Yes, it was lovely.
All righty then. Well, with that being said, have a great week. Until next week, see you on the radio. InsuranceMatchmaking.com.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.